Welcome to Cushman & Wakefield's GTA Market Watch. My name is Paul Morse, Senior Managing Director, Office Leasing, and it is my pleasure to introduce my colleague, Stuart Barron, National Director of Research. Stuart will share his insights and his observations on what is actually happening in the GTA office markets as of Q2 2011. Welcome, Stuart.
Thanks, Paul.
We continue to experience a very active, dynamic office leasing market, particularly downtown, and lots of discussion about demand. Talk to us about what's driving this demand.
Sure, Paul, my pleasure. It's kind of important at the outset when you're talking about demand to sort of put it all in perspective. And one of the things that I've done is I've had a look at the last recession and kind of compared what demand was like then to what demand was like now. And between 2001 and 2003, interestingly, almost 4 million square feet of occupied space became unoccupied, whereas during our current kind of since the fourth quarter of 2008, since this recession hit us, we've actually seen positive absorption of 2.3 million square feet. So when you compare what's happened here now to what happened then, it's really been a 6 million square foot difference in terms of overall demand strength. And that to me is really quite remarkable.
And what's causing this demand? What are the kinds of industries that are absorbing the space?
We saw it begin with the banking sector, and everyone's aware of that. What's really fascinating more recently, over the past 2 quarters, it's really expanded across all sectors. We've seen George Brown lease 90,000 square feet at 330 King Street East. So we've seen education growing, we've seen professional services growing, we've seen PwC grab another floor in the past quarter. But we've also seen patterns of change in terms of demand parameters in downtown Toronto. For instance, we've seen the reverse migration take place. We're seeing SNC Lavalin lease almost 80,000 square feet at 18 York. That's normally kind of a suburban type of tenant, an engineering firm leasing that kind of space in downtown Toronto. We've also seen Toronto move up the rankings, as most Canadian cities have, in terms of the desirability as a result of our economic strength and how we performed, not just how the banking sector has performed, but how the overall economy has performed over the past 2 years. And key transactions to kind of highlight that would definitely be Coca-Cola's lease of 99,000 square feet in the past quarter at 333 King Street East. Google's lease of almost 80,000 square feet in downtown Toronto is also kind of a telling sign of the type of tenants that are looking to Toronto to satisfy their occupancy needs.
You know, what I find fascinating is that we've had over 4 million square feet of new office products built and now substantially leased. In the case of 25 York Street, for example, now 100% leased. And yet and one would think there'd be a bit of a pause as a result of that development cycle, but it seems as if there's more evidence that more office buildings will be built or announced in the next year. Tell us a little bit about what you're seeing there.
Yeah, absolutely, and it brings to question the kind of how tight the market is right now. I mean, the market in downtown Toronto is about 5.1% in terms of vacancy. Historically, this would be the tightest point in history entering a long-run expansionary cycle. So there's no question, as a result of that, we've seen upward pressure on rental rates to the point where, both in conjunction with how tight the market is, that we hear all sorts of rumors in terms of new developments that may kick off to bring 2 to 3 likely million square feet of new space to downtown Toronto. Keep in mind that the number of large contiguous blocks that remain in kind of is really quite limited. So if you're a large tenant looking in downtown Toronto right now, you have to seriously consider the new towers. It also means that tenants in the marketplace have to look at least 5 or 6 years out in order to consider their occupancy needs, which means that you've got to lock down your strategy with a broker and understand the timing of how the elements of your occupancy strategy is going to unfold to make sure that the space will be available when you actually need that space.
Are you seeing any evidence of slowdown in demand? Are we seeing any early signs of sublet space coming back to the market, or because we've come through such a strong kind of bull market? You know, is that sustainable, and are you seeing evidence of change now?
Yeah, two great questions. And one is that, you know, there are 3 points in time in history when we've had kind of a superheated level of demand. One was just before the Asian financial crisis, which ended in kind of the summer of 1997. We saw 9 quarters of phenomenal growth in downtown Toronto, where demand for premium space was 400,000 square feet a quarter. Demand for all classes was 500,000 square feet a quarter. The second period in history where we saw superheated demand was during the tech boom, and we were kind of both heavily involved in that market. In the 5 quarters ending Q4 2000, the demand for Class A space in downtown Toronto was about 325,000 square feet a quarter, and total all classes was about 550 a quarter. So those are 2 very heated demand periods. Now, more recently, in our current expansionary period, the 6 quarters ending at the end of 2010, we actually saw average absorption for premium space hit 440,000 square feet a quarter in downtown Toronto. So we are right in the midst of one of the 3 hottest periods in history, but takes you right into your second question, which is that yes, we are seeing demand kind of moderate towards a much more reasonable, much more sustainable long-run number, which is kind of in the 150 to 175,000 square foot demand per quarter for premium space in downtown Toronto. And what would change that dynamic is if we saw additional significant migration into the downtown. But in terms of natural growth in downtown Toronto, it's more likely will be around 150 per quarter.
These are healthy numbers, and I suppose these are the numbers that give confidence to the developers that they can go ahead and build and take the risk and hopefully see at least 2 new buildings downtown. You mentioned the reverse migration, but surely I know the suburban markets have been somewhat active. There's been increased activity in the last quarter, especially in GTA West. Talk to us a little bit about what's happening in the suburban nodes.
Sure. And if you look at the numbers themselves, what you see is kind of a flat vacancy rate. But underneath there's churning waters happening in the GTA West and GTA East markets. Tenants are very active in the marketplace now. You're seeing a lot of acquisitions and consolidations as companies try to kind of grow their businesses. As a result of those acquisitions and consolidations, you're getting a fair bit of space that's being displaced into the market as people drive their space standards down as they as they address their workplace kind of strategies and push their space standards downward. At the same time, we're now seeing evidence of growth, particularly in the GTA West, and it is on a kind of concentration by concentration level. We've seen a fair bit of demand in the 427 corridor area. We've seen a fair bit of demand in the Airport Corporate Center, which has seen its vacancy rate drop from 15.5% down to about 11.7% over the past 3 quarters. Now that is a significant drop. And as a result of that, we're seeing initial upward pressure on rental rates in those specific markets. However, as a whole, the GTA West rental rates remain stable. There's still some good deals to be had, and overall vacancy actually rose just marginally over the quarter. But we expect demand to be to be increasing, the momentum of demand to be increasing by end of year.
Exciting news about both the Pepsi deal, which was announced some time ago, but most recently the Target deal that Hoop just completed at the Airport Corporate Center. Any details on that we should know about?
Yeah, it was a great deal for Hoop, a great deal for Target. As you know, Target has kind of entered the Canadian marketplace and will be opening up between 100 and 150 different locations across Canada. And to support that, they leased about just under 200,000 square feet in the Airport Corporate Center at Aero Center 5. And that basically filled that building and completely and had a big impact on overall absorption in the West in this particular quarter. It's those types of anomalies and those types of companies that are now shifting their radar towards Canada that is beginning to have an impact on overall demand in our markets.
Good news across the board. Stuart, thank you very much for sharing your insight on the trends and what is happening in this very exciting market that we're in today. And thank you for joining Cushman & Wakefield's Market Watch.